Hey, good morning once again to all of our options traders. And this is a question that I get a lot is about this somewhat mysterious connection between the debit and credit spreads. And it's important to understand why the vertical spreads are priced the way that they are. One of the questions that comes up a lot is I'll hear traders say, well, I found that I got a better reward off of the debit spread side or off of the call side compared to the puts, and therefore it's better. Sometimes that might be true if it's because of a skew, but other times it's not. It's simply because of the cost of carry or the interest rates. So, to find out what this connection is all about and have a better insight into your vertical spreads, let's go find out more about the debit and credit spread connection. And before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, let's start off with a debit spread, debit call spread. What you're going to do with this strategy is to buy a call and sell a call at a higher strike. Now, they have to have the same expirations. That's just true for all of your verticals. So, for example, let's say that you buy the May $100 call trading for 8 and you sell the May 105 call trading for 5. This is a long 100 105 vertical call spread. Now, in the business, we would say that this is executed for a net debit of 3. And that's just the net cost between the two options. You're going to spend 8 for the 100 call, you're going to receive 5 for the 105. So that's where that net debit of 3 is coming from. Now also remember that the most that a vertical spread can make is the difference in strikes. Because in this instance, you have the right to buy shares for 100, but you've got the obligation to sell them for 105. So if you're buying shares for 100 and selling for 105, the very best you could do is 5. Well, if you paid $3 for that opportunity, then your maximum gain is 2. Well, the question we want to ask now is what is the 100 105 credit spreads price? So this is the debit spread with the calls. What would the price be if we sold the put spread that created the same risk profile? In other words, that they're both bullish. Well, to understand that, we have to first look at some theory, and that's going to come from a strategy called the box spread. Now, the box spread isn't used too much at a retail level. It's used quite extensively at, let's say, a market maker's level, but that doesn't mean you shouldn't understand it. There's a lot of tremendous insights that can be developed and gained by understanding the box spread. So, this is a strategy where you are going to buy a call spread and you will buy a put spread with the same strikes. So, for instance, let's say that you buy the 100 105 call spread that we just saw, but then you also buy the 100 105 put spread. Now, when you buy the 100 105 put spread, you're buying the higher strike put. You're going to buy the 105 and sell the 100. And if you do that, if you buy the call spread and buy the put spread with the same strikes, it is now a position that is guaranteed to be worth the $5 difference in strikes. Now, before you get too excited and say, hey, this is the road to riches because I've got a guaranteed trade. Remember, we've talked about this. If there's a benefit in the market, you must pay for it. Yes, the market knows that that's guaranteed to be worth 5, so the market's going to respond by pricing it at the present value of the $5 difference. So in other words, because everybody knows that it's guaranteed to be worth 5, it gets reflected in the price. Remember, price is the equalizer. That's going to equalize all of those benefits. So let's now take another little step and figure out the difference between the present value of something versus the future value. And that's going to help us to understand the vertical spreads. So this whole idea of present value and future value comes from finance, and it really just means that money can have different values depending on what point in time that we're valuing it. So for instance, if you have $100 in your pocket right now, we call that the present value or today's value. But let's say that interest rates are 5%. That money is going to grow to 105 in the future. And so we might say that 105 is the future value in 1 year, assuming that interest rates are 5%. So notice that when we go from today's value to a future value, we multiply by 1 plus the interest rate. Well, anything that we can do in math, going from, let's say, left to right, we can undo by going right to left. We can do what's called the present value of a cash flow. So let's say that somebody owes you $105, but it's 1 year from now. How much should you be willing to accept today to settle that debt? Well, again, a lot of traders would say, well, if you owe me 105 bucks, you owe me 105 bucks. Well, that's not true. If it's due in a year, it's worth less today. And we know that because we can take this 105 figure and divide by 1 plus this interest rate. And so 105 divided by 1.05 brings us right back to the present. So if somebody owes you 105 in the future, why would you accept 100 today? Because you could invest it at 5% and still have the same 105 in the future. They're just two different ways of looking at exactly the same cash flows. They're just valued differently because of time. And so this is where we get what's called the cost of carry. And this is important for understanding the box spread. So the cost of carry is simply the interest lost from holding a position. So again, let's say that the risk-free interest rate is 5%. If you have a 1-year $5 box spread, that means it's going to be worth, guaranteed, $5 in 1 year. But that doesn't mean you should pay $5 for it. That'd be kind of dumb to pay $5 today, have to wait a full year and get $5 back. What makes sense is if you can buy it for less and be guaranteed to get $5. Now, again, the reason you shouldn't get too excited about this as a strategy is because, not even counting commissions or bid-ask spreads, is because the market knows about that. If it's guaranteed, the market's going to price it at the risk-free rate. Market's going to say, okay, if we're guaranteed to get $5 in a year, I should be willing to spend $5 divided by 1 plus the risk-free rate, which we just set up here as 5%. You should be willing to pay $4.76 today. And again, that is called the present value of that box spread. Now, also, we would have to account for dividends if they're paid, but just to make the example simpler, we're going to ignore dividends. But if a dividend is coming up, you're going to see even bigger discrepancies in the prices than what we're going to see here in just a moment. So, for example, let's say that these are two strikes. We've got calls on the left, puts on the right. So let's start off with the debit spread over on the call side. If you buy the 100 strike and sell the 105, that is a vertical spread. It's a debit spread. If we did the same thing over here on the put side, if we're going to buy the put spread, you would buy the 105 put and sell the 100 put. So this is one way to look at the vertical spreads. I can look at just the calls, kind of in a vertical column over here. I can look at just the puts. But I can also look at these horizontally. So for those of you who understand the synthetics and have seen some of the previous videos on synthetics, will recognize that if you're long a call and short a put of the same strike, that's going to behave like a long stock position. And I often tell traders to think of this as a long position because it's a long distance between these numbers right here. So that's a very quick visual to show you that it's a synthetic long position. Well, conversely, if you sell the call and buy the put of a same strike, that's going to be a synthetic short stock position. It's going to behave just like short shares of stock. And again, we can see this visually because it's a short distance between these numbers. And so if you are synthetically long at 100 and also synthetically short at 105, you're guaranteed to have this position worth $5. So what does a pricing model say that these options should be worth? So for this example, I'm using 1 year to expiration, 5% interest, and 20% volatility. But it really doesn't matter which numbers you use. The idea will come out exactly the same. I'm just using 1 year because it'll make the calculations a little easier. Now, the pricing model says that under those conditions, the 100 call is worth $12.01 and the 105 call is worth $9.35. Over here on the puts, it tells us that the 105 put is worth $6.80. That's what you'd have to pay for that one. And the 100 put is worth $4.70. That's what you could receive from selling that. So take a look. If we look at these again vertically, just at the calls, it's going to cost you $2.66 for this call spread. What about the puts? You're going to spend $6.80 and collect $4.70. It's going to cost you $2.10. So notice that if we add the two prices up here, if I buy the call spread and I buy the put spread, it's going to cost $4.76. Exactly what it should cost for a position that's guaranteed to be worth $5 in 1 year. So you can see that all of the math works out. Now, because of these prices here, I can gain some insights into the credit spread for the puts. I know that if I'm going to spend 266 for the call spread, I can figure out the price of the put spread. So here's how you're going to do it. We're going to look at our debit spread over here. We know that it costs 266, and therefore the maximum gain must be 234. Remember, it must be worth the difference in strikes. So if you spend 266, the most you can make is 234. Well, if that's true, then over here, the pricing model says that you're going to receive 210 for selling the spread and therefore have a max loss of 290. So notice that we have two spreads that are both bullish. We can either buy the call spread over here on the left, that's the debit spread, or we can sell the put spread. Over here is the credit spread. Now again, some traders will look at this and they'll say, why would I want to have a maximum loss of 290 with the put spread when I could spend 266 and have a lower loss over here? And with the debit spread, I can make 234. With the put spread, I can only make 210. But in this case, it's definitely an illusion because remember, it's all got to work out mathematically. What's going on here is that we have a cost of carry issue. Now, I'm not going to show the details, but if we spend 266, we have to pull $2.66 out of our money market for 1 year. And at 5%, that's going to come up to be about 13 cents in cost of carry. Over on the put side, if I sell it, I'm going to get a credit of 210, which I could invest at 5%, and that's going to come up to be about 11 cents. So there should be about 24 cents in kind of a net interest benefit here. And that's why the put spread is 24 cents less in this maximum gain over here compared to the call spread. So once we account for interest, they're really the same. And that's why you have to be able to dig deeper and not just jump to conclusions and say that the call spread is better. If you really want to say it's better, it's because of a skew that's going on. And for that, we have to look at implied volatility, not interest rates. But we can see the mechanics are very much the same. If you spend 266 for the call spread, we need the stock price to rise to be worth a maximum of 234. If you sell the put spread and you collect 210, you just can't have it fall because the maximum you can make is this credit. But if it falls, then your maximum loss is 290. So again, we can see that if we know that the present value of the box spread is 276, I could also say, well, if I have to spend 266 for the call spread, this one must have a maximum gain of 210. Because I could either buy the call spread for 266, or I could buy the put spread for 210. Or I could sell the put spread for 210, put me on a bullish curve like this. Either way, it's 210. Doesn't really matter whether you're selling it or buying it, the price of the spread is 210. So if I have to pay 266 over here, synthetically I'm buying this put spread for 210 or a total of 276. And that's where the total of this 476 is coming from. And I know that because of the box spread. So because of interest rates and because I made this a year out, that's why we're getting some fairly different numbers here for max gains and losses. However, if you have zero interest rates, or let's say a very short term until expiration, in which case the cost of carry isn't going to be a whole lot, these prices become very easy to figure out. Let's say that the 100-105 call spread is a $3 debit. What we would call the corresponding put, which is the 100-105 put spread, must be a $2 credit. And that's because the prices must add up to the difference in strikes. There is no cost of carry. And so the idea here is that for short-term spreads, the present value is close to the full value or the difference in strikes. And that way they will add up to the full $5 or at least very close. So even though interest rates might be 4 or 5%, if it's only 2 weeks until expiration, you're talking about just pennies for cost of carry. it might add up to 498, but it's going to be very, very close to 5. So for example, let's go back to our call spread. We're going to look at our synthetic long here, our synthetic short. All right, so there's our synthetic long and our synthetic short. Pricing model says that this is 932 and this is 702. Now remember, this is without interest rates. Over here, the 105 put is worth 952 according to a pricing model. The 100 put is worth 682. See, now the cost of the call spread is 230 and the cost of the put spread is 270. So if I spend 230 for the call spread and spend 270, I've boxed it in. It's going to cost me 5 to earn 5. Why would you do that? Because again, we're either under zero interest rates or such a short term until expiration that the interest rates just don't matter. So if you see that, for the most part, I think it's safe to say that most traders will be trading shorter term vertical spreads. And so this is really another insight to understand. If the debit spread is trading for 230, I immediately know that the maximum gain is 270. Well, I already know that if I look straight across the board to the put spread, it should be trading for 270. I can buy the put spread for 270 and have a bear spread, or I could sell it for 270 and have a bull spread. And therefore the maximum loss is 230. So again, it's just a matter of which direction. If we spend 230 here and the stock rises, I can get a maximum of 270, or I can get a credit of 270 and just be at risk if it falls, in which case my maximum loss is 230. But as before, if I look at the amount that I can spend here versus the credit here, if I add those up, in this case, it's going to come up to 5, or at least really close. And so that's the connection that most traders kind of live by for shorter term spreads. So I know that if my debit spread is 230, I immediately know that the corresponding put spread is trading for about 270. If the call spread is trading for 2, the put spread's trading for 3, and so on. And if you understand those connections, it will help you to uncover what might be some skews. And that's really where you want to focus if you're going to trade vertical spreads with an edge in your favor. Don't worry about the cost of carry. It's just an illusion. It's not necessarily making that spread better. It's just accounting for the potential interest over time. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.